Hey everyone, and welcome to The Explainer. So in 2025, the world of crypto is going through this absolutely massive shift. Seriously, the Wild West era, it's giving way to a whole new landscape of creation, commerce, and, well, compliance. Today we're going to break down what all of this actually means. So let's just kick things off with a pretty wild question. What if you could launch your very own currency, right now, from your laptop, in less time than it takes to watch a movie? I know, it sounds like something straight out of science fiction, but it's now a very real and actually surprisingly simple reality. To really get a handle on this new era, we have to start at the very beginning, the act of creation itself. How is a new digital asset actually born in 2025? Well, the answer has become radically, almost unbelievably simple. Okay, let's dive right into this. First off, forget any idea that you need to be some kind of coding genius. Creating a crypto token today is a lot more like building a website with a tool like Squarespace. You just connect your digital wallet to what's called a no-code platform, you fill out a simple form, what's your token's name, what's its symbol, what's it for, and then you pay a tiny fee. And that's it. The platform handles all the complicated stuff, deploying the smart contract, which is just the piece of code that brings your token to life on the blockchain. Now, a really crucial point here is the difference between a coin and a token. Think of it this way. A coin, like Bitcoin or Ether, is the native currency of its very own blockchain. It's the foundation, the ground floor. A token, on the other hand, is built on top of an existing blockchain. It's like an app that runs on an operating system. And that's exactly why they're so much easier and cheaper to create. You're not building the whole system from scratch. And this number right here, just shows how incredibly democratized this whole process has become. The cost to deploy that smart contract and bring your very own token into existence, it's about $35. That's less than a nice dinner out. I mean, think about it. We've gone from a world where creating a currency required a whole nation state to one where it literally costs less than a new video game. It's a huge change. Okay, so you've created your token. It exists. Now what? Well, it needs a place where people can buy and sell it. And that brings us to the marketplaces of the crypto world, the exchanges. But as you're about to see, not all exchanges are created equal, not by a long shot. You've basically got two fundamental models. On one side, you have centralized exchanges, or a CEX. These are run by companies kind of like the New York Stock Exchange. Then on the other side, you have decentralized exchanges, or a DEX. These are automated platforms that just run on smart contracts. But here is the absolute key difference. A CEX holds your assets for you. But on a DEX, you always control your own private keys. That means you, and only you, have the ultimate say over your funds. What's so fascinating here is how the cost to build these things really explains why they're so different. Building a CX is a massive project. We're talking upwards of $1 million because you're essentially building an entire financial institution from the ground up. A DEX, on the other hand, is way cheaper because it just leverages the existing blockchain, and it gets its trading inventory, what we call liquidity, from its own users. It basically replaces all that expensive infrastructure with automated code. And here's something that might surprise you. There's this common belief that DEXs are always cheaper to trade on, right? I mean, it makes sense. You're cutting out the middleman. But the data from 2025 actually tells a different story. When you average it all out, the trading fees are remarkably similar. That big cost advantage that everyone talks about, it isn't nearly as clear-cut as you might think. All right, so we've seen how tokens are made and where they're traded. But the single biggest crypto story of 2025 is the arrival of the referees. After years and years of ambiguity, a clear, global rulebook is finally taking shape. And believe me, it is changing absolutely everything. This quote just nails the new reality perfectly. That old idea of crypto as this borderless, rule-free frontier, it's crashing head-on into the hard realities of global finance. And right now, preventing illicit activity is the #1 priority for regulators all over the world. So, at the global level, the standard is being set by an organization called the Financial Action Task Force, or FATF. Their travel rule is the key piece of the puzzle. Basically, it requires crypto businesses to collect and share customer info for transactions, just like banks have done for decades. And while it's officially on the books in nearly 100 countries, the data shows that most are still really struggling to get it fully implemented. Now, if we zoom into Europe, we have the landmark MiCA regulation, and this thing is huge. It took this messy patchwork of 27 different national laws and replaced it with one single unified rulebook. Now, a crypto business can get a license in, say, France and operate across the entire bloc. It has completely transformed Europe into one of the most stable and predictable crypto markets on the planet. Meanwhile, in the United States, the focus has gotten much more specific with the Genius Act. So instead of a big, sweeping crypto bill that covers everything, the US is targeting stablecoins. Those digital currencies that are pegged to things like the US dollar. And the goal here is crystal clear. Make them safe and reliable by forcing them to have one-to-one backing with high-quality reserves, and then plug them into the existing anti-money laundering system. And if you're sitting there wondering if these new rules actually have any teeth, well, look no further. The crypto exchange BitMax had to pay over $230 million in penalties specifically for failing to comply with these exact anti-money laundering regulations. The message from regulators could not be louder or clearer. Compliance is not optional anymore. So this huge wave of regulation is literally redrawing the global map of crypto. For our final section, we're going to zoom all the way out to see how these new rules are creating a landscape of very clear winners and losers and what it actually takes to be a leading crypto hub today. So what does crypto-friendly even mean in 2025? Well, it's definitely no longer about having no rules. It's all about having the right rules. The jurisdictions that are winning are the ones striking this very delicate balance, protecting consumers and fighting crime while also fostering innovation and providing that legal clarity that attracts serious, big money investment. And this table gives us a fantastic snapshot of that new global landscape. Singapore is pretty widely seen as the gold standard. They're just excelling across the board. The EU's major strength is its massive unified market. The UAE has really positioned itself as a magnet for new startups, while the UK is just methodically and deliberately turning its crypto ambitions into concrete, enforceable policy. And all of this brings us to the final critical question for the future. As the rules of the game become solid, who is going to lead the next massive wave of financial innovation? Is it going to be the permissionless, fast-moving innovators who defined crypto's first decade? Or will it be the compliant, regulated institutions that are now finally entering the space? The answer to that question is going to define the next chapter, not just for crypto, but for finance itself.